Good evening, everyone. This is Milan Vaishnav. I welcome you to my Market Simplified series, something I have not done over quite some time, but now I intend to do it more often over the coming weeks and months. So today, as we connect, intention of today's interaction is to discuss some upside potential and the downside risks that we are facing in the markets. Um, we are not here to discuss general elections because that is something millions of people are anyway doing and doing it in a far better way. So I'll keep that topic aside, but I'll be discussing the volatility that we are about to face over the next coming days. And while we face that volatility, how should we navigate that period? That is point one. And while we do that, and while we enter that volatile week beginning Monday, because Saturday would be the exit polls, so markets would start dancing to its tunes from Monday onwards. Tuesday is the general election counting, so volatility will be at its peak. But regardless of talking about what sectors that will benefit if BJP comes and what if they come with difficulty and what if this and what if that, we won't be discussing that, but I would be discussing the kind of upside potentials that we are looking at the broad technical scenario, and we will be and what are the downside risks that we are facing. Going ahead, I would also be talking about certain stocks that we should be looking at over the coming weeks and months, regardless of what the market does pre-election or post-election reviews. So I'm here basically to discuss the broad technical setup of the indices and that of the stocks. And I will be discussing overall the kind what quantum of volatility that we can expect going ahead from here, and the sum total of all. What are we looking at if the market get a big thrust on the upside? What are we looking at if the market has any negative surprises in store for itself? So I won't be discussing typically the general election results and what sectors would benefit because it's a no-brainer that everything goes well as expected by everyone. We will see state-owned enterprises, PSEs, etc., doing well, state-owned banks. But that would be a no-brainer to discuss. So my focus is on certain stock specific, keeping certain broader and bigger uh, macro picture in view, macro technical picture in view, and that is what we are going to discuss going ahead from here. So to begin with, my focus would be on this thing on VIX that has been relentlessly rising over the past couple of weeks. Normally, we have indexes and VIX sharing inverse relation. Generally, when the key indices rise, VIX generally comes down, and vice versa. But especially over the last 4 to 5 weeks, we have seen Nifty and VIX rising in the same direction. But where has VIX risen from? That's the big question. In roughly sometime in the end of April, we have had we had VIX testing a low below 10 rupees. That is all, sorry, below the level of 10. So it was almost 9.85 or something like that. From that low of 9.85, today we were in a striking distance of 25. It was almost 24.75 from where it retraced a bit and has closed. But from its low point until today, VIX has seen a massive rise of 138% in barely 5 weeks or so. That is something we need to take a look at because in India, unlike the US, we don't have derivative products on VIX. Therefore, we cannot gauge what the market participants are seeing. Otherwise, for example, if we had VIX futures, then if VIX futures are trading at a good premium, then we could certainly anticipate that VIX is going to inch higher. That is what market participants believe. But as of now, we don't have that here in India. So all we can say is that the VIX has risen from 9.85 to over 24. which translates into a rise of almost 138% in last 5 days. Now, what is little bothering to see is that in the month of May, both Nifty and VIX have risen simultaneously. Both have risen, both have moved in the same direction simultaneously, which is something not a good point or not a comfortable point from a technical perspective. The reason is that if you look at the historical instances, whenever VIX and Nifty have risen simultaneously, VIX has ended up acting as a lead indicator of an impending corrective move. It has acted as a precursor and has hinted us well in advance that a corrective move might be in the offing. And whenever VIX has risen in tandem with the markets, it has led to formation of at least an intermediate top, if not a major top. So this is something we need to take a look at, regardless of what happens during the election. I'm not going to talk about elections and election results because everything is being talked about. So what I'm trying to look here is a broader technical picture that has emerged over the past couple of weeks. So Nifty and VIX rising in the same direction. Uh, that is something I'm not so comfortable with, and we need to take a look at it with a little bit of with caution going ahead from here. Moving on, if you take a look at the index's setup itself, now I was talking on Economic Times sometime on Monday, yes, on Monday, and where I'd said that the upside, going by the options data, the upside potential is not more than 23,150 to 200 range. And precisely from there, the market took a U-turn and has declined over, say, almost over 300, 350 points from that level. Now, if we just take a look at what could be the picture if a minorest of the correction takes place, and which would be no sin on the chart. So, taking a look at the weekly chart of Nifty, we can see that the high point of the Nifty is at around 23,200 odd levels. That's fine. But the nearest support that we can see is that of 20-week moving average. 20-week moving average is the fastest moving average on any chart, generally speaking, if you're talking at a end of day charts or end of week charts. And that is nothing but the middle point of the Bollinger Band. That is the nearest support that we can take, and that also is at 22,229. I will round it off to 22,230. So the minorest of the correction is, I will not even call it correction. Such retracement happens even during a primary bull run. So the minorest of the retracement can take the index lower by almost 700 points from the current levels. If you take the round, if you round off the Nifty closing at 22,900 and round it off the 20-week moving average to 22,200 levels, then 700 point of retracement is something which is possible, even if the current uptrend remains intact. Now, even during the bull run, the indices or the stocks have the tendency to take support or retrace up to 50 DMA or 50 period moving average. In this case, 50-week moving average that lies almost 1,000 points, 2,000 points below the current level. So the kind of running away or the kind of deviation from the mean that we have seen in our markets is a reason enough that in case of any eventuality, we will see some good amount of the retracement that has got room on for itself on the downside. Now, another uncomfortable thing is that beginning for the most part of 2024, if you see that the markets have given us incremental highs, but at the same time the RSI is not done. So we are seeing a continued negative divergence on the RSI, which shows a lack of internal strength. So it might not be a reason enough to sell. I don't say that you once the market opens tomorrow go out and sell. I'm not saying that. But if such things continues to stay on the chart, one has to be a little cautious. And if certain levels are violated, if certain key supports are violated, like somewhere around 22,200 or 22,000 levels, then it would act as a price confirmation that intermediate top might be there. So, in nutshell, what I'm trying to drive home a point is that We have around 400-500 points of upside in Nifty going by the broader technical levels, but we have almost twice or 2.5 times the potential downsides that we have, even if we travel up to just the 50 period MA, which will still keep the primary uptrend intact. Similar picture emerges on Nifty Bank. We have seen that it went a striking distance near 50K mark, around 9,900 odd levels, and it has failed that breakout once again. Today, it has slipped below its breakout point of 49,300, and it has again now another concerning factor is the creation of a large rising wedge. Rising wedges are generally reversal patterns because both of the lines are rising and they tend to converge going ahead. So it's a kind of a very large rising wedge, I would call it. So it is not a classical wedge, but still it is. And here as well, we have seen that most of the upside, this point and this point, for example, when the Bank Nifty made its high and attempted a breakout, it had come with a negative divergence of the RSI, and this is something quite concerning because it denotes the lack of strength. And what we saw that subsequently the index gave up, went very close to its 100 DMA and has bounced back again. So all in all, what we are looking at is that the most recent high, that is 50,000, say for example, continues to remain a primary resistance for Nifty Bank, so which is around 850 points potential on the upside. But the downside potential, even if it tests its previous bottom, that is 100 DMA, it is just very close to 47,000. Translating into a downside potential of 2,000 points from the current levels. Again, the potential upside um, is just half of the it's just half of the downside risks that we are seeing on the index. Again, Nifty Bank weekly charts also will show a similar picture here as well. Right now, the 20-week moving average, the nearest one, that also is almost 2,000 point away at around say 47,200 odd levels. So 47,200 levels, even if the Nifty Bank tests those levels, it would still continue to remain in a primary uptrend. Again, for the bulk, the last quarter of 2023, when the index marked an incremental high, it had come with a negative divergence on the RSI, and that's the reason that we are seeing the index trying to achieve a breakout, trying to make an incremental high, but not doing so convincingly. Ultimately, it is getting retraced back inside its trading range. So now, what the point again that I'm trying to drive home is that um, the technicals would be defined if we get something very good in the coming week. Technicals would be defined again if we get something very bad. But if we get something in between this, and if we have to follow the technicals, then the downside risks are twice than the potential upsides for both the key indices. That's the point. That's the main point that we need to see and take care of. Moving on from here, the main reason of this is that unless we get a huge positive thrust on the upside, we are going to see this level acting as a resistance for Nifty and Nifty Bank. The options data now, if you look at with a very near term, very short term time horizon, we need to know about two important dates. One is the 30th May, which is going to be the weekly Nifty expiry as well as the monthly derivative expiry. If we take at the OI setup, we have a maximum call OI standing tall at 23,000, a maximum put OI at 22,500. We are exactly in between that. So Nifty may move 250 points on either side going ahead from here. But I draw your attention to this level of 23,000, which has the maximum call OI. and therefore, unless it is taken out convincingly, we expect it to act as resistance. Now, this is for 30th May. Now, let's see for 6th June weekly expiry, which would be the date when Nifty will have another weekly expiry, but the election results, etc., and all the madness would be out of our way. Even that week sees the 23,000 levels standing tall as the maximum call away. So we still continue to consider 23,000 as resistance. The difference being that it is also acting as an inflection point because maximum put away also stands tall at 23,000. So for the coming week, we unless violated for this week and the coming week, unless it is taken out convincingly on the upside for this week as well as the coming week, 23,000 continues to stay as resistance. Number one. Number two, for the coming week, 23,000 also acts as a deciding level below or above which the market would take a definite trend because both of the maximum OIs, the call as well as the put, um, are on this particular strike price. Now things get pretty more interesting here when we combine Nifty 30th May and 6th June expiry. 23,000 still stays a strike where there is a maximum accumulation of the call away. So this means that until and unless these levels are not taken out on the upside, we continue to see the levels of 23,000 acting as a strong resistance. Now, I have not shrunk the number of calls available for number of strikes here, but above this, we have another similar high OI at 23,500 and at 22,000 levels here. So, what the market anticipates is that in case of any volatile moves, markets are preparing themselves for a move of 750 odd points above the current level, 700 750 odd points below the current levels, and therefore this is the quantum of the volatility that the market participants are preparing themselves for. Now, before I say anything else, let me point out that options data, OI data, it's not a lead indicator, it's not a lagging indicator, but it's a I will call it a coincident indicator, something that it shows you the situation at this point in time. So at this point in time, we have 23,000 to 23,500 as an upside swing for the market. On the lower hand, it has 22,500 to 22,000 as shown by the OI data, which is of course subject to change. It is just giving you us. It is just giving us a situational awareness kind of a thing, which as of now, what the things are it's showing. So right now, with the markets closing around 22,700 odd levels, let's say we are prepared. The markets are preparing themselves for a rise of around, um, say, 7 to 800 points on the upside and around 6 to 700 points on the downside. So this is the kind of gap, this is the kind of volatility that the market participants are gearing up for. So I am just trying to quantify the wildest of the possible moves that can happen over the coming week and what options data is showing. That's what we are trying to make sense of. And if we are trying to make a sense of it, we see that, as I just said, I repeat, markets are seeing the possibilities of a 700 to 800 point move on either side as it tries to navigate the coming week that would be full of volatility beginning Monday. Now, if you take a look at the sectoral setup, it still shows that some of the defensive plays are playing out. In the leading quadrant, we just have Nifty Auto consumption and mid cap has rolled into the leading quadrant along with metals. Metals are primarily strong because of the weaker dollar or dollar staying below, say, 105 mark dollar index. We have service sector slipping back inside the lagging quadrant. Nifty Bank losing its relative momentum against the broader markets. Realty picking up a bit. Nifty Media showing some good strength and momentum. Another defensive play that is playing out here is that of Nifty IT, which is right now relatively underperforming the broader markets, but it has now changed its trajectory. If you can see the tail has started to move up eventually. Once the JDKRS momentum is able to cross above 100, we will see the phase where a potential outperformance will begin from this sector. Another defensive play we are seeing here is the strong rolling of FMCG into the improving quadrant. Whenever a sector enters the improving quadrant, it is interpreted as a beginning of a phase of its potential relative outperformance. So, Nifty FMCG playing out, or rather, consistently improving its relative performance against the broader markets. Nifty IT trying to improve it, starting the process of its improvement of relative momentum can be viewed as something that playing out of a slight defensive play in the markets. Let's take a sectoral glance. These are different Nifty sectors that we are looking at. This is something I'm looking at. For example, Nifty Auto is in good downtrend. Everything is downtrend, but here a specific attention goes to Nifty IT, which is showing a potential trend reversal here, because if you see that this couple of last lower bottoms in the price have come with a bullish divergence of the RSI, because while the index made its lower lows, RSI has not done so, and in fact, at one point in time, it has broken out of this congestion, mild consolidation, and this is laying strong foundations for a trend reversal for the IT index. So, IT index is something that we will need to keep in mind going ahead from here. Otherwise, if you see realty index, it's been marking higher highs, but RSI is not so. So for the bulk of the weeks over the past, some of these indices have made higher highs along with negative divergence of the RSI. CNX realty is one such index. Another such index I see is that of PSU banks. It did mark an incremental high. It had come with a negative it came with a bearish divergence. The high or the breakout did not sustain. So all these things, when the going is good, you will see even stocks and sectors with less internal strength moving higher. But if we are here to take some little defensive view on the market, we need to find out those stocks and sectors whose relative strength is improving, or they have shown some sort of bullish divergences on the lead indicators, and that's where we need to stay invested for a resilient and relatively better performance going ahead from here. So IT index is something that I'm looking at. It is showing strong bullish divergence on the charts, with the price marking lower lows, RSI not marking lower lows, and therefore emergence of a bullish emergence of a bullish divergence. Another thing that I'm looking at is that over the last couple of months, March, April, and May, we have seen pharma staying is sideways, but now sits on the verge of a breakout. RSI has already marked a 15-period high, which is bullish. So again, this hints at potential play out of a defensive mindset in the market. Going back here, if you look at the FMCG has also reversed its trend, and right now it trades above both its 50 and 200 DMS. So here what we are seeing is that high beta sectors are in uptrend, but somewhere they are seen losing its internal strength. Somewhere they are seen likely to take some breather. But if you look at a traditionally defensive space, we have IT showing some mild bullish divergence. We have pharma, which sits on the verge of a breakout, and overall the broader market like mid cap also stays in a continued uptrend. So these are the things that we need to keep in mind going ahead from here. Now, before I move to a couple of stocks that I'm looking at, I would like to take a look on the crude oil. Crude oil has very silently rose around 5% over the past couple of days. If we talk about WTI crude from the lows of I'll tell you from the lows of 76, it has very quietly and patiently rose to this level, and it is currently in a symmetrical triangle. We will see the oil trading range getting narrower over the coming weeks, but any move above 90 will lead to a serious breakout in crude oil, and it will affect the stocks that are directly or inversely related to this. So to begin with, there are a couple of stocks that I'm looking at. Not keeping the elections outcome in view, I'm not here to discuss elections. I'm this just for sake of clarity. I'm saying this. I'm here to look for those stocks which are having improving relative strength and which are likely to do better over the coming months and quarters. And if at all we get a downside surprise in the markets, these stocks would be the stocks that you need to accumulate with each downside it offers. So, in nutshell, what I'm trying to drive home the point is that all up moves are not supposed to be chased. There are certain moves that we use to protect our profits. Our markets are in that stage. We are more towards our lifetime highs. We have downside risks that are far higher than their upside potentials, and therefore this is the time we need to get a bit defensive and pick up those stocks who are either breaking out or who are seen either putting a bottom in place. That will give us a very resilient existence over the coming weeks. So to begin with, ONGC is one such stock I'm looking at. It's trading in symmetrical triangle or right now. It has support at its 100 DMA. But that being said, even if we are getting any downside surprises, it would be a good opportunity for us to accumulate the stock with each decline. Another setup that I'm seeing that is in Reliance. After marking its high here above 3,000, we are saying the stock is in a declining channel. It is seen consolidating on the weekly charts, but by and large, even if it declines until its 50-week moving average, which is 2621, even then, with each such decline will qualify for accumulation, because when it broke above this rising trend line, Reliance has given us a multi-year breakout, and this breakout remains very much in force. So we need to discount the near-term volatility. We need to disregard the noise and use this every opportunity that we get during the declines to accumulate this stock as well. The third thing I'm looking at is ITC. As I just said, FMCG sector is doing good. ITC enjoys a significant weight in the index, and it is the stock which is showing improvement in its RS line, that is the relative strength against the broader markets, and it is right now seen resisting its 200 DMA, but overall attempting to form a bottom for itself and move higher. These are the weekly charts. It has got a very strong support at 400 levels. This stock also qualifies to get accumulated during each decline. By and large, going ahead from here, it is expected to show very resilient performance as compared to its peers. Another relative underperformer is SDFC Bank. Right now, we saw it bouncing back from levels of 1380 or 1390 or levels. Again, it tested its 200 DMA around 1500, 1525. It's consolidating that. But if you take a long-term view on this chart, it had hit a high of around 1725 or 35 odd levels sometime in October 2021. And since October 2021 until the early 2024, when the levels got retested, practically the stock has returned us nothing. And another important thing is that the support level on the daily chart also coincides with the 200-week moving average, which is placed at 1490. So, by and large, the stock is in a very wide trading range. It has risen or it has virtually returned nothing since October 2021. And going ahead from here, it is likely to relatively outperform the broader markets, And from the banking space, this becomes one of the safest stock to accumulate at current levels. Any downsides, if we are offered, would be a blessing to us to acquire the stock at a cheaper price than what it is today. So these are the couple of stocks that we should be looking at. Now, this is the pharma sector. I'm analyzing it on a larger chart. Um, And before I talk about these sectors, just to repeat, HDFC Bank, ITC, Reliance, and ONGC are a couple of large cap stocks that would offer us extremely good entry opportunity with slightest of the declines if they offer. If we are here to see any negative, if we are here to see the markets reacting negatively to anything, or some knee-jerk reactions here and there, and if we see some declines, then these four large cap stocks would make an excellent entry for your portfolio if you are prepared to hold it for certain months, if not for certain longer than that. So, in short, these are technically sound stocks. Two of them are directly related to the potential up move in crude, that is ONGC and Reliance. HDFC Bank is one of the premium names into the private banking space. Technically speaking, it is seen putting a bottom in place and staging a rebound. And the fourth one is ITC, which is an FMCG measure, a classical defensive play that can play out during negative volatile times in the markets at large. This is Nifty Pharma. It is testing or retesting its high point several times since March. Any breakout above 19,500 will lead to a serious, again, a good breakout on the in the pharma index, which will see some good quality stocks like Lupin, Cipla, and Glenmark, Dr. Reddy doing good over the coming weeks. And IT index is what I was talking about. If you take a larger view, we see that the prices have constantly marked lower lows, whereas RSI has not. And this has led to the emergence of a bearish divergence of the RSI. Now the only thing that we need to wait is that for price confirmation, the moment IT index goes above its 200 DMA of 33,946, we will see this index beginning a period of potential relative outperformance against the broader markets. So, by and large, what I'm trying to drive home a point is that we might see technical rebounds uh, playing out over the next 1 or 2 days. We might see some markets spiking up on the upside uh, as it navigates the exit polls and the election outcomes. What I'm trying to drive home a point is that of a larger, bigger picture, that all these up moves, until and unless it results into taking out of 23,500 levels on Nifty, should be used to protect your profits on your positions. A fresh, aggressive, high beta positions can be taken if you see the Nifty going past 23,500 levels, which is the place where there is a huge maximum accumulation of the call option OI, which indicates a strong resistance. So the market participants themselves are figuring out 23,000 to 23,500 levels playing out as a potentially strong resistance, and that is something which is also visible on the technical charts as well. So the bottom line is that it would be good if we get a good positive reaction from the markets to the election results, which are almost, that could come on the anticipated lines, except minor intricacies with that. But overall, by and large, even if we are getting a good reaction to the markets, I would not suggest jumping onto the bandwagon without thinking. And rather than blindly chasing the up moves in the market, it would be very wise to use that up moves to book profits into the stocks and sectors that have run up too hard and too much ahead of their curves, and instead move money to the sectors which are showing signs of bullish divergence that could lead to a potential bottom formation, and to those stocks and index we are that are showing good improvement in its relative strength. Because The relative strength is the primary thing that you will need going ahead from here. That is good. If your holdings are having good or rising or improving relative strength, they will do better than the others when the times are good. But when the times are bad, they will give you a lot of resistance and take much lesser damage on themselves during the market decline. So relative strength is something that you must perpetually look at while taking exposures in any stock or index. So through this, all that I've tried to convey is that the upside potential for both the key indices is much less than the downside risks that we are facing. So rather than trying to chase the 500-point rally in the Nifty, it's better that we worry about a potential 1,000-point decline that the Nifty can have. So I'm not talking this in literal sense, but what I'm trying to emphasize is that we have downside risks which are far higher than any upside potential. So until and unless these two key indices, Nifty and Bank Nifty, don't move past their previous high with a good amount of thrust, it would be prudent to continue to use those up moves to book your profits, take some money off the tables into the things that have run too ahead of themselves, and rotate your money, or rather focus on sector rotation and be in those sectors which are a bit defensive in space. They're a little bit low beta, and they are showing potential improvement in their relative strength, which may in turn lead to their relative outperformance over the coming weeks. So this is the larger picture that we need to keep in mind. So this is what it was all about. I would like to thank all of you who have joined us and connecting with us on this Market Simplified series. I will be connecting with you more often than before. Please feel free to leave your feedback. You can reach out to me directly or just subscribe to this YouTube channel for more updates. I'll connect with you all soon. Thank you so much for connecting with us and watching me on this Market Simplified series. Thank you so much.